You're listening to A Deeper Dive, a part of the Winsight Podcast Network.
What is the state of the restaurant business and M&A right now? Hello, this is Jonathan Maves, Editor-in-Chief of Restaurant Business. And in this week's episode of A Deeper Dive, I speak with Jim Balis, the Managing Director of CapitalSpring, to talk about a wide range of topics. Jim is a friend of the podcast, and I like having him on to get a sense of what is going on, and he does not disappoint. We talk in general about the current state of the industry, including labor costs, restaurant sales, and the potential impact of technology. But we also talk about mergers and acquisitions. CapitalSpring is an investment firm after all, and how these are going right now. The M&A markets have been frozen for the past year and a half amid high interest rates, low profits, and a lack of agreement on prices between buyers and sellers. But there are signs that this environment is improving of late. Jim talks about this, why that is, and where the market is headed. It is an interesting discussion on A Deeper Dive this week, so please have a listen. All right, I am here with Jim Balis. Jim, welcome to the podcast.
Thanks for having me, John. Appreciate you inviting me to be on.
All right, super. I see you got your EBITDA hat on, which shows you where your mind is at right now.
Yes, sir. Yes, sir. EBITDA, store level EBITDA, those are definitely a focus of ours.
Mm-hmm. How is speaking of EBITDA? Where do you see, from a profitability standpoint in 2023? Where do you see the industry at? I mean, do you see that improving? I mean, are things getting better? Are things just sort of holding steady? Where are things at?
I mean, generally what we're seeing is an improvement to margin. A lot of the price that was taken last year to offset inflationary pressures, as some of those inflationary pressures have eased, specifically in commodities, both food and packaging, you're seeing natural improvement to margin from that price that was taken. Labor pressures continue, although, they've certainly eased quite a bit. So I'm sure you're hearing the same thing from others, but, it's easier to hire people now, equally challenging to retain people. But we're not seeing the same wage inflation. It's leveled off quite a bit. And as tipping has sort of proliferated even into quick serve, that's also helped with some of the labor inflation. So margins generally, have improved, I would say, in the first and second quarters of this year.
Mm-hmm. This morning, as we recorded, restaurant job numbers came out, and there was it seems like job growth in the industry has slowed a little bit. Appears that maybe people are slowing down a little bit with some of their hiring somewhat. Are you concerned? I mean, do you think, I guess my big question is, are you concerned about where sales are headed right now? I mean, do you see sort of the economy sort of shifting into a slower gear at the moment?
I think the job growth may be easing a bit, which, could be a combination of some automation that's coming in and other factors. The new development and new restaurant growth has, I think, eased a bit as well, which, I think takes some of the job growth away. But from a sales standpoint, it seems that sales generally are holding, at least with respect to, the portfolio business that we have and the businesses that we're involved in. So, we're not seeing any sort of massive slowing down. People seem to be continuing to spend on food, which is good for all of us.
Yeah, that's one of the big surprises to me still. I mean, I would have thought after the menu price inflation that we've seen over the past year and a half to 2 years, I just would have thought that people would have cut back, and they don't appear to be. I mean, maybe on the margins for sure. I mean, lower income consumers, you definitely have some people that are looking at, different types of restaurants, or they're sort of cutting back in one way or the other. But for the most part, it just seems like sales have really held and continue to hold even with all of this. That's surprising.
Yeah, and I agree with you. I mean, it really has been somewhat surprising to see exactly what you're talking about, despite, a lot of price being taken and, we've seen pricing anywhere from the mid to high teens to into the 20s the last few years. Despite that, people continue to spend. Interesting too, I would have expected an enormous amount of trade down, so maybe the person that goes to cheesecake now goes to, Applebee's or another concept, full serve concept that's, a lower cost. But, we're not even really seeing that to that much of a degree, or, even instead of going to Five Guys, maybe I'll go to Carl's Jr. or, a QSR burger concept. Across most categories, including fine dining, we're seeing strength, and I think we're all somewhat surprised about that. I think everybody's sort of a little bit, in the corner waiting for that, okay, is it going to happen, news break? But, so far it hasn't happened. And I think we're all somewhat surprised about it.
Yeah. I mean, we've all been waiting for the other shoe to drop or whatever, and it just really hasn't. And now I'm kind of at the point where I just don't know that it does, unless really the economy really sort of takes a tumble in some form or fashion, which I suppose eventually it does. But even that, I mean, from an economic perspective, I mean, we haven't really seen a ton of evidence at the moment yet that the consumer is going to drastically cut back spending, which everybody's been predicting now for about a year and a half. It just hasn't. It's just not really happening, and we don't really see any evidence in restaurants. Not really.
Yeah, I mean, there's one small exception, I would say, and that's delivery. We are seeing specifically in full serve a pullback on the massive delivery that we saw, during and post COVID, where people sort of got in the habit of ordering now. And I think it may have been when gas prices spiked. I think people became a little bit more amenable to I'm just going to go pick it up, ordering, so takeout is holding or actually going up. And, it's interesting in a lot of the full serve restaurants where it may have been 5% years ago, is now in the 15-20% range, which adds another expense factor for us, which is packaging, especially in full serve where there's a number of sides and, packaging can be a significant cost associated with that. But, we are seeing a little bit of a pullback in delivery. And then the metric that a lot of people don't talk about is transactions and traffic. And while sales seem to be holding a lot of it from price, we are seeing transactions, not be as positive as sales. And a lot of the sales may have been driven by some of the price that was taken.
Yeah. So people are cutting back, but because of price, it appears that they're not necessarily doing so.
Yeah.
On the delivery question, do you think that the delivery cutback is because people are themselves kind of cutting back because delivery is an expensive transaction, or do you think it's just because consumers are normalizing, or do you think it's a bit of both?
Yeah, I mean, I think it's a bit of both. I mean, I'm sure, you've experienced it with your kids. Me too. I mean, you order something and, it's a bit of a sticker shock by the time you see the total at the bottom, excluding the 99-cent over $10 toast charge that is going to be added to most bills here now, but which is extremely well hidden in the last transaction that I processed. But, I think, there's a bit of sticker shock when you order something now delivered and, the restaurants are taking price to offset the commissions. The commissions are massive because a lot of delivery companies are, losing money or barely making money. So I just think that people look at it and say, I'm sitting at home, I'll just go pick it up. It's easier and, it's less expensive and, I have the same experience. And I think people are cutting back for that reason.
Yeah. Jim, I am a cheap bastard and a control freak. I really do not order delivery all that much unless I am doing it for some work related reason. I just go get the food myself. I can't. But I mean, when I have, we've done a number of examinations of delivery costs versus picking up yourself. And to me, it just makes zero financial sense to do that. And with costs going up the way they are, to me, it always just seems that from a budget standpoint, delivery is something that you absolutely can cut back on. And we hear that from Domino's. And if you look at pizza, for instance, Domino's and Papa John's as well, you see their numbers and they're their delivery numbers are down, and frozen pizza sales has taken off. Walmart sells their frozen pizza sales jumped 30% in the first quarter, which is insane. And pizza is kind of really one of the easiest things that you can shift from grocery to restaurants and the other way around. And it seems that that's probably probably one of the better indications that we have of some sort of consumer cutback, for sure, because they still like pizza, which is good, but they're not.
I agree with you. What's interesting about, the pizza delivery segment is they've struggled on drivers. So, the times that had typically been 30 minutes escalated to 60 minutes. And, you have kids at home screaming, they want to eat, that becomes a big factor in choosing between delivery. And the next time you're at the supermarket, you're saying, I'm just going to throw this in the freezer so I don't have to wait 60 minutes or, whatever the time period may be. And then also, if you've ordered from some of the major pizza players, when you get the product delivered, it's a little bit of a sticker shock as well. You don't see a lot of the price points that you see advertised on TV. And I think, there's a big push and, for some of the pizza players to move into the carryout space, which had really been owned and probably still is to a large degree by Little Caesars, which is, a QSR pizza operator. And, you see Domino's pushing heavily into that takeout, category because they're trying to capture some of that market share. And I think, they are able to execute at a much lower price point, which is a lot more attractive to their consumers. And, I think you'll see some of the other players do the same, really push takeout, knowing that A, they're having trouble with drivers, and B, they can really push value promotions from a takeout perspective because they don't bear the same expenses as they do on delivery.
Yeah. Plus, carryout is just more profitable for the operator. You don't have, especially if they're ordering by app, which they should. Frankly, nobody should call a pizza restaurant. I'm sorry, if anybody listening is stop calling the pizza restaurant.
Yeah, stop calling. It's not good for us either. We can't answer the phone anyway. We have no labor.
No, nobody has any employees to answer the phone. But yeah, definitely Domino's has really done I think a really good job. That's where all their growth is. Well, not all, but that's where so much of their growth over the past decade has come. It's actually from carryout. They've always done a really good delivery business, but they tell you is that most of the businesses, most of the growth is with carryout. Actually, delivery, for all the amount of we talk about delivery and have talked about delivery for the last 3 to 5 years, it's still a really small percentage of the overall restaurant industry. And most of, I think, most of the industry is still carryout, takeout, drive-through, and, dine in. Delivery is such a tiny percentage. And apparently expensive one.
Yeah. And you're seeing more drive-through in the pizza category. Little Caesars has a lot of drive-throughs, and I think, a lot of the operators in that system, to the extent they can open a drive-through, they will, because it's such a convenient method of pickup. Yeah.
Plus, they can have wide enough windows, unlike McDonald's in the 1980s. So, all right, I want to shift gears here a little bit and talk about M&A. I hear you know a little bit about that. Let's go from one of your jobs to the other one. The M&A market has been slow, though it seems like maybe it's starting to move a little bit. Where do you see where's restaurant M&A right now?
Yeah, I think there's a couple of factors driving M&A. I mean, the short answer is it seems to be picking up. I think it had slowed down quite a bit, and I think a lot of sellers were on the sidelines waiting to see what was going to happen, selling off of margins that they may have experienced last year. So looking back at a TTP or, trailing 12 periods or 13 periods, wasn't that attractive. And, now as we look at the business, and I think we've had this conversation before, a lot of the way that we're forced to look at it is really more forward looking, which bears some risk, certainly, because you're speculating as to the performance and the commodities and labor is going to hold. But I think, as some of those trailing data points are falling off, I think people are coming back into the market and saying, okay, the buyers are going to buy off of some forward looking. The trailing doesn't look as bad because, we've got some, solid numbers under our belt for 23 and maybe a portion of the end of 22. And so you're seeing the M&A market come back a little bit. Obviously financing is the biggest issue right now. The banks are extremely skittish. Some have dropped out of the space altogether. Others are just becoming a lot more conservative in how they're approaching underwriting restaurant transactions. So that's really going to be the big unknown. I think interestingly, and this is probably very anecdotal, but, some of the M&A activity that we're hearing about is coming from operators who are just tired. It's been a rough few years. We've heard a couple, of groups where maybe one of the executives actually had some health issues or other things. And I think, fatigue has really set in. And I think that actually is driving some of the activity, and people are saying, maybe I get a lower price, but, I'm not sure I could do this for another year. Another 2 years. And, they're going to market and trying to take the money and run.
Yeah. The best example of that to me is in the McDonald's system.
Yeah.
They've had very high turnover really since 2021. A remarkably high amount of turnover, actually, given the performance of the system and where things are going. And, and I've talked to a number of the operators that have sold and many of them are longtime franchisees. And you hear that pretty consistently. Now in that system, they have some unique issues, but just generally speaking, it's pretty indicative of what we hear from franchisees in particular is that it's just been, it's just been difficult. I don't want now in McDonald's. They were getting 8 to 10 times EBITDA for their stores. Honestly, if you're kind of close to retirement anyway, you just cash out, take your millions, and then just go buy a hotel or something. And then,
but interestingly, it had been such a generational business. There really is no other brand that had been as generational as McDonald's. And so it's surprising, that you're not, there's a family here where I live. I think they're on the third generation. So not to interrupt you, but it is interesting that when McDonald's franchisees start selling, it's certainly a sign.
Yeah. It's fine to interrupt, Jim. We're good. We're good. People are here to hear you, not me. So, but that is. We could actually talk about McDonald's for ages because, that is, because a lot of the people that have left have been generational franchisees who just really tired of the business. McDonald's itself has changed the way it deals with their franchisees in sort of amazing ways. And really one of the more underrated stories in the industry right now is how McDonald's is shifting from focusing on that generational franchisee to trying to bring in new franchisees. Really one of the more fascinating stories that I've encountered, ongoing pieces. And it's a big reason why you're seeing so much pushback in the system, because a lot of it's coming from these generational franchisees who've been there for multiple years.
Yeah.
But you're right on just how I think tired people are of operating, and the fact that some people are willing to take a lower price rather than try to wait it out a couple of years is probably a little, I don't know if I would go so far. It's a little disturbing, frankly.
Yeah, no, definitely. And, it has been tough. We've been hit with so many different headwinds here, and navigating through them has just been so challenging. And, it's a very tough operating environment in our space. And, specifically, I would say, full serve back of the house and quick serve across, any position within the restaurant. Good managers are hard to find and hard to hold on to. And, generally speaking, what we've had to do as operators, whereas in the past it was a focus on operations and, high levels of execution. And it's not that we're not focusing on that anymore, but there has been a shift to include now the team member as, a big focus of ours where, I think historically we had taken the team member for granted. They're not letting us do that anymore. And, the dynamic has really shifted, where, it used to be if there was a no call, no show, they come in the next day, and it's sorry, John, you're fired. You can't no call, no show. Now it's, how was your day off? I hope you had a nice rest. What did you watch on Netflix? Welcome back. It's just a very different dynamic than what it was before. And, a lot of groups, ours included, have reformulated their mission statements and their core values around the team members. And, there's a lot of effort put into retention and engagement and, lots of different things around the team members. And it just it's another element of operations that we hadn't dealt with before that, now you have to deal with, in addition to a guest that may be disgruntled and, the lettuce that comes in that's brown or the tomatoes that are damaged. And, you're trying to navigate through all of the issues with supply chain and hiring people and staffing. Now it's the people that you have. How do you take care of them in such a way so that, they don't leave and they're engaged and, they like working there and coming to work every day? It's, I think people, are getting, as we've talked about, just a little bit tired. It's a tough operating environment.
Oh yeah. Yeah. And we it's easy to forget now just how much garbage operators and employees have been through really the last 3 years. And we just go back to February 2020 or March of 2020, and then you got the pandemic, and then, they were brought back in an environment which everybody was worried about getting sick, and, you have to wear masks, and then they're the ones that had to sort of, restaurant employees had to enforce mask rules, and then you come out of this, and then they got supply chain shortages, and then you have labor shortages, but, you didn't have workers showing up, and, people, short staff was a very, very common issue, and, and things like that. It's just been, the last 3 years have probably, I suspect, tested operators like at no other point in industry history.
Yeah. And, coming full circle, I think that's driving some of the M&A, frankly, I think, because clearly, prices aren't at their peak. It's difficult to find financing. So, it's certainly one of the factors that's being considered, as sellers look to go to market. So,
yeah. So now we've seen in the last this year, on the top end, we've had a couple of IPOs that have done pretty well, Kava and Gen Korean, which is fascinating, actually.
Agreed.
Yeah, fascinating. Fascinating concept, fascinating IPO, very quiet company. Drives me nuts. But do you see that as potentially, because the last time we saw, an IPO market like this, it really did have sort of a trickle down effect and sort of led to higher valuations overall, and then spurred a lot of M&A. Do you see that happening this time?
I think they're somewhat mutually exclusive, honestly. The IPO market, I don't fully understand, how some of these businesses can go to market and rely so heavily on growth being the value driver of the business versus, core business optimization and other factors. But, I'm not a real public equities guy, so I don't know a ton about what drives the value other than earnings. And, I've been frankly surprised by the results of some of these IPOs, but I think some of the other M&A activity, regardless of the IPO market, is going to continue to, get hotter over time, especially as, some of the financing gets worked out. And I think you're going to see some of the special financing groups. I mean, CapitalSpring is extremely unique in that, we can provide equity and debt and financing to businesses and transactions. And I think you're going to see a lot more creative capital come into the market like CapitalSpring, because I think that's what's going to be needed here. I think a lot of the banks are going to tighten their belts quite a bit. I think it's going to be difficult to find people to finance some of these transactions. And I think it's going to spur some, more creative financing.
So are you seeing more demand on the debt side at this particular point or anything like that?
I mean, we're seeing more than we did before. We have a fund that we can lend out of that is strictly debt now. So, we can provide, just financing to transactions that, fall within the parameters of underwriting, obviously. But, we're definitely seeing a pickup as more of the banks, are saying, well, we're not really sure. Maybe we'll land at this multiple or that multiple. And, we're much more flexible and creative. So, we're getting a lot more inbounds on, some of the financing opportunities than we were before, certainly when the banks were a lot freer with capital. Plus, our covenants are very different. We understand the business, blah, blah, blah.
Very nice. Jim, this was awesome. I really appreciate you joining me again on the podcast.
You bet, Jonathan. Thanks for having me.
And that should do it for this week's episode of A Deeper Dive, which was edited, as always, by Kimmy Spoons Kazmarek, artwork by Nico Hines. You may find this and other episodes of the podcast on our website, www.restaurantbusinessonline.com/article/deeper-dive. You may also find them on Apple Podcasts or Spotify or anywhere else you get your podcasts. I'm Jonathan Mays, your host, podcast producer, and the editor-in-chief of Restaurant Business. Thank you for listening.